Hello there, and welcome to the Apartment Building Investing Podcast. I am your host, Michael Blank. I am super excited that you're here. Now, it's been a tough time finding deals this year. I mean, Q1 was super hot, can't find deals then. Then COVID hit, can't find deals then. So it's been super hard to find deals, yet people are still doing deals. In fact, I was really excited. Some of our mentoring students in our mentoring program just closed their deal. And our shout out to Bernie Lund, Justin Elliott, and Steve Chen, who joint ventured to close on a $1.4 million deal, 29 units, and they each raised about $250,000 each. So congratulations to you guys. And we have several students that are closing deals in the next few weeks, and some who have closed deals actually during COVID as well. So if you want to find out more about the mentoring program, go to themichaelblank.com/mentor and set up a strategy session with us. If you value mentorship, you have the ability to invest in yourself, that is the best money you can invest versus any kind of real estate you can actually buy. So check that out, really consider it, because it allows you to accelerate the time frame and avoid big mistakes. So congratulations again. Again, for us at NightHawk Equity, which is our investment firm, it's been a real challenge. We've looked at far over 100 deals all year, and we are just now doing our first deal of 2020. Not for lack of trying. We've got close a few times as well. And, at the heart of that is really Garrett Lynch, our director of acquisitions, who has been tirelessly working on a deal, and now we're finally closing one. It's 130 in Atlanta. And I wanted to kind of pick his brain a little bit and just kind of, hey, how did we get here? What are our, how do we select our markets? How do we underwrite deals? How does he build relationships with brokers so that they give him these off-market deals? How does he stay in touch with those people? How does he change his underwriting to accommodate what's going on in the market with COVID and the debt and different things we're finding right now? So this is going to be a deep dive on how do you find deals, how do you underwrite deals, how do you close deals, what's working right now. And Garrett has years of experience in this particular category of multifamily investing. And so let's get him on the show here. Without further ado, let's get right into the show with Garrett Lynch. Garrett Lynch, welcome to the show.
Hey, Michael. Thanks for having me.
Yeah, I look forward to jamming here. We have meetings like this every single week where we kind of talk about, hey, what's in the pipeline, because you're our bulldog deal finder. You do so many other things. We're going to talk about deal finding today. We're going to talk about underwriting and maybe negotiating. And it's been a tough year finding deals.
It has been tough.
It really has. We're just in the process of closing our first deal in 2020, and it's not for lack of trying. Tell us a little bit about, first of all, how long you've been doing this, like the deal finding thing.
So I'm going on probably 9 years of deal finding. I had about a year of cutting my teeth in the industry, and then the rest was just finding deals. And I figured out that was the best way for me to add value to the industry in general. And I like doing it. So I started out, a while ago starting out, but mostly like my strategy's changed quite a bit from when I got started. But yeah, I've been at this for a while.
Okay, how has your strategy changed since you got started?
Well, in the beginning, I only knew the south side of Chicago, so I was finding deals that we found out after we bought them that they had a very heavy cash flow and they're D-class deals and really not a lot of equity. So I figured that out the hard way. But we were buying portfolios of 2 flats, 3 flats, and single-family homes in the south side of Chicago, Section 8 stuff. And so I would just look for that. And it was a price per door. You just tried to find the best price per door you could get on them. They're all kind of the same because, the tenants mess them up anyways. So that was my first start in there. I was good at that. So we found a lot of those cash flow heavy properties. And then we started to get into, the mid-sized multifamilies, like 70 units to 120. And then we bought our first deal in Memphis that was 380 units. And that was like a big jump in size. And so then, but we still, my strategy was more so before I met you guys was just, finding the best price per door, not looking at a ton of metrics and comparing it to others in the market. And so my first portfolio was 3,400 units, and I sourced over 70% of those deals personally. Before exiting that and jumping in with you guys. And then I got a lot more granular on what exactly are we looking for? What is our strategy? How do we underwrite to get, that exact metric and dialing that in so that we don't step outside of our box. And we set certain rules in place on the underwriting. And so it's really been dialed in a lot more from my initial strategy until now, where we're repositioning, C plus to B minus deals into solid Bs.
Yeah.
And it's been an effective strategy so far.
Well, here's the thing. I mean, yes, your strategy has changed over the years, but so has ours. And what I always say, that people who do their first deal, great, got to do the first deal because it triggers the law of the first deal. But you're never going to do that deal again. In fact, you look back in your first deal like, God, why did I do that dumb deal? What a dumb deal. Why did I do that? And people kind of beat themselves up over that. And, certainly I did over I would never do my 12-unit deal again, and you wouldn't do whatever on the south of Chicago. However, here's the thing. It's that deal got us to where we are today. So beating ourselves up is kind of pointless, it's senseless. However, even for NightHawk Equity, we have started to get some clarity around what we want. And early on, because of the deal desk, where people brought us deals, and people watching, listen, go to the michaelblank.com/partner and learn more about that. We have this deal desk where you can bring deals. And in the beginning, that's kind of how we built our portfolio, which served us really well. The problem with that is we were over here, we were over there, we were buying this size, we're going to buy that size. And we noticed that over time, as you build your portfolio, it became very difficult to manage these portfolios consistently. And in the beginning, it doesn't matter as much. You can have one over here, one over here, just to get your track record. But how have we started dialing in kind of our criteria over the last few years?
Yeah, so the dial-in it's a learning process in general. Obviously, I think it's more important to get your first deal done as long as it makes sense and it's going to be profitable. Obviously, you don't want to go backwards. But it was me working with you guys in the beginning, and we had to have discussions around what is our next deal going to look like? What's our capacity on the equity raise? What is our capacity on the debt? What kind of debt can we get? What does that structure look like? And then what is our next deal going to be based on what those metrics are? So we were saying, hey, we think that we could raise, we did on our last deal, let's say 5 million. We think we could do 6 million on the next deal. So we need to look for deals that are somewhere in, the 12 to $15 million range. Right. So it's a progression based on what you are confident that you can do. You don't want to jump up and do a $35 million deal and your last deal was 5, because then you're not the chances of you raising all that capital and qualifying for the debt, it makes that range a lot harder to close that gap. And so I think with us, it was just figuring out, all right, what was our last deal? What's the next one looking like on the capital stack side, the debt side? What do we feel confident we could definitely achieve on our next deal? And we're willing to risk money on the risk capital side to go after. And then, let's find something that fits the strategy that we're doing, which is adding value to existing properties on the interior renovations and exterior renovations. And then the size, okay, what was our last size? And what do we want to push it a little bit? Do we want to stay the same? What does that range look like? And so it was those two things, I think, that allowed us to arrive at our next progressive, deal in sequence.
I think the other thing also we had lots of discussion about is the area. We have realized that going deep in one area has inherent benefits. We found that being spread out geographically, one property here, made it very difficult to manage that. And talk a little bit about that. And the impact of co-locating deals in a particular area.
Yeah, so a very simple example that I learned early on is if you have multiple deals in one market, somehow those deals perform better because you can share resources. So I had a deal in one of my best portfolios in Columbus. We had 3 deals in that market that were all over 300 units. And those were performing the best because if a manager left the property or staff went out, we could replace them really quickly with staff from another. Hey, could you go cover this? So you're able to share resources in the markets. And so we've done a similar thing. In Memphis, there's quite a few assets that we have there, and they have, there's a benefit to having that because you can pull resources from there to go to your other properties. And then also, your asset manager or whoever's in charge of looking after the property, you can hit a bunch of properties in one trip and go put your eyes on it a lot easier than having to fly, over to LA and then to, the other side, East Coast. So having a more centrally located portfolio in your markets has a ton of benefits. And we definitely found that.
There's a lot of people who are looking in top tier markets, and even from an investor standpoint, finding deals in Dallas or San Antonio or Houston or some of these areas are super attractive. And a lot of people are looking there. There's nothing particular wrong with that. Now, we've decided to go somewhere else. We've decided to go into secondary, tertiary markets. But how, and obviously you went to the south side of Chicago, right? So even the market selection criteria have changed over time. But talk about how do we select markets, or how should one select markets in general?
Yeah. So you want to make sure that, I honestly, the way that I start out is getting an idea of what markets have, first off, I like, but there's a combination of it's not just having a market that you like, it's having enough resources to be able to operate once you get into it. Too many people, and also the inventory. You got to have inventory too, right? So as an example, you mentioned top tier markets. Let's just use Dallas. Everybody loves Dallas. Okay. Well, there's a lot of groups that launch out there that want to buy in Dallas. And you're dealing with a lot of people that have been there forever, and they're getting a lot of that deal flow. So you have quite an uphill battle if you're just entering into Dallas just to begin there. So maybe you look at a market that's, not quite Dallas, where there is a ton of inventory, but it's not as overheated. And you go and check that out. And you got to look at the population growth and the job growth and just overall economic growth of that market, so that you have a tailwind behind you versus a headwind. You can make money in any market, don't get me wrong, with the right strategy, but it's a lot easier if you're in markets where you have good things happening there so that you can achieve the higher rents that you're looking to get. And we found that to be true absolutely in our market selection. So what we're looking now are more secondary markets in better locations where we can add value to a property. Maybe there's a property with all classic units that's in the best area of a market with great economics. And then we will, go deeper into that. And so I think, when you're looking at markets, you want to do your research and your homework on it, but understand that there has to be inventory. And there has to be enough resources. And what I mean by that is our management staff. And because if there's only a handful of managers in a market, when you get in there, they cycle out and you're stuck. And the resources after you close. So if you look for those two things, I think you'll have a good shot.
Okay, so let's talk about because you mentioned inventory a lot, and I think what you mean by that is enough deal flow, right? Because you need to analyze enough deals and make enough offers, because it's a little bit of a numbers game. So let's take one of our markets is Huntsville, fantastic market, growing very, very rapidly, rising tide, but it's a smaller market. And how do we make up for the fact that it's a smaller market? What do we do to compensate for the lower inventory?
So really the only thing you can do in that circumstance is to build deep relationships with the brokers that know where the deal flow is, and even owners. So that's one market that we're in and we like a lot. So I've taken the time to meet with a lot of these brokers one-on-one, getting to know them, so that we get the first deal flow as it comes out. We're seeing all the stuff that we know about. I know about every single potential off-market deal that exists in there right now, and still there's not a lot of options. So if you want to be in a market where there's less inventory in general, you just have to have all the right relationships in that market to be able to see what's coming out. And then if you have a reputation on top of that, that helps a lot too.
Well, let's talk about broker relationships. People always ask, well, how do you find deals? And my answer is always brokers, brokers, brokers. And you just said again, brokers. We don't send out yellow letters. We don't put up bandit signs, that kind of stuff. Now, we are starting to call owners, and we can maybe shelve that for a second. But so far, the primary source has been brokers, and more specifically, because of relationships, off-market or semi-off-market deal, especially the more recent ones. But how do you build? Think back when you first started calling into Huntsville, or you first started calling into wherever you were calling into, and maybe our reputation precedes us, but let's say it doesn't, right? How do you build rapport with that broker, and how do you get them to not only take you seriously, but then actually call you with off-market deals?
Well, you need to stand out.
Yeah.
And the way you stand out is you have to think what most people are doing to them. All right. Most people are tire kickers. They see a lead on LoopNet or Crexy or something. They hit the button, get the info, and then they never respond once they figure out the numbers don't work. So the first thing that you can do to stand out is to just give them an answer back. If you like the deal or if you don't like the deal, get back to them quickly and let them know either way. Call them up. Hey, we love the deal. We'd love to make an offer. This is what we're going to do. I'm going to send it over today, fast. Or we'll wait for the call to offers and we'll compete. Okay. The second thing is if you don't like a deal, call them back and say, you know what, we don't like it for X, Y, Z, but we'd really like to be on your list. We'd love to give it a first look. We have this track record over here. I'm partnered with this person that has this track record, and we want to get on your short list, and we're willing to do whatever it takes. And so many people don't do that.
No, they don't. I remember asking some of our brokers how many people actually respond when they blast an email. Only 20% actually got back to them. So standing out, you're now in the top 20%. Now, what else do you do to kind of build rapport with brokers?
Yeah, so another thing you got to think about is they all have deep relationships with other people as well. And so it's really touching and calling them and becoming friends with them, relating to them in some way. If you go into town, taking a second to meet with them for coffee or lunch, one thing that a lot of these brokers never even see the clients that they work with, you get in front of them and relate to them in some way and build that relationship where they feel friendly with you. And you even tell them about if you got another deal going on or whatever, and you start sharing your successes with them. I think that goes a long way. Like I'll give you an example. The deal that we have now was listed with another broker in Atlanta, and they had it listed, and then it went to another brokerage, and I told her all about it and how we're under contract on it, and she was like, oh my God, and I've never done a deal with her, and we have this great rapport, and I just keep it very open. And I went to NMHC is a really good way to really quickly get through and meet those people.
What's NMHC, Garrett? What's NMHC?
It's a conference. It's held once a year, where literally every broker under the sun goes to it. Okay. And you just go to that conference and meet them. It's worth it. It's worth the money.
Just to summarize what Garrett is saying here, sometimes, or frankly, often, you can accelerate the relationship building by getting together in person with the broker. Even in this environment, and you're kind of a crazy guy, but you've actually flown around, and you can see the result of that, because right now people are like, oh no, I'm not flying, I'm not going anywhere. And so you talked about standing out. You stand out as someone who hops on a plane, goes there, spends some time with a broker, visits some property, and they're like, wow, this guy is amazing. And this is not the first and only time I've heard this. People who are doing deals right now do the same exact thing. They're literally driving or flying, and they're building relationships with brokers. Anything else you can think of before we move on? This is good stuff.
Yeah. If you compete on a deal and you lose, that builds a ton of rapport right there. So even if you lose, I've lost so many deals this year.
What?
But those brokers, don't forget, it's a numbers game. Remember, I've been disheartened. I've been crushed. I've gotten my soul ripped out of my chest so many times this year. And you get back up and you try again.
Tell me more, Garrett. I didn't know you were crushed and your soul was...
But I hid most of that.
Well, share with the audience, because here's the thing. I hear it all the time. I've been making offers and I'm not getting anything. Well, how many offers did you make? 2 or 3? Like, okay, give us a little more what does Garrett do on a numbers and
What do
daily
I
basis?
do is I underwrite hundreds of deals. I have a process. So I would say if you're not good at underwriting, you got to get good at it. That's one skill you need to pick up, is figure out how to underwrite. You can take an online course. Michael's got a great underwriting tool. You got to figure out how to do it so that you can burn through deals quick and understand what's a deal and what's not. It's going to help you in all facets of the business. So I would say you got to get good at that so that you can go through a lot of deals quickly. Some people rely on analysts, fine, but those are the bigger guys that got companies and they don't want to maybe deal with that. If you're trying to find a deal, you got to get good at that skill. And then you get the OM, the T12 and rent roll, and you underwrite the deal. You can underwrite it in a day, get the initial underwriting done. And then if it's a good deal, try to make an offer fairly quickly, or at least know when the call to offers is so that you can compete. So then you're in the competition, or there's typically right now there's a competition going on, but you have an offer out, you know where the pricing is, and now you're in front of a broker, you're building rapport with the broker, okay? And you're probably going to lose a few times or many times, but at least you took a stab at it. You started that rapport building process, and then when the right deal comes, think about it, you just need one. One deal could change your life if you have never done one, or even if you have. There's a lot of there are a lot of good things about that, but it's always, I learned this early in sales when I was doing nice sales, door to door. It's a numbers game. You're going to get better at your percentages and your pitch and your closing ratio and all that stuff. But at the end of the day, you got to put those offers out there. You got to get the underwriting. The funnel has to be as big as possible, starting with the deal flow, going to the underwriting, then going to the LOIs, and then eventually you're going to get a deal. That's how it works. Yeah. That's the funnel.
It has been a little disheartening, and you're closer to it because you're kind of on the forefront. You're going through these buyers interviews. You're putting these packages together. You're spending hours and hours getting into the best and final. Then there's a best and final, and then you lose after all that hours and hours. You just want to throw up your hands and go, "This is for the birds."
And then you have to get back on the bike. You can't slow down. So there was one specific instance. I flew to North Carolina. I checked out 3 deals. One I really wanted, really bad. I did everything you could possibly do. Wrote the offer, came in with hard money, built a great relationship with the broker, had the debt lined up. I was ready to pull the trigger and take this thing down. We had the track record. We had everything. And I'm like ready to win. The waiting is the hardest part, right? You're waiting for like a week to hear back from the seller. And I'm like, please have an answer for me. Please have an answer. This is worth millions of dollars. Okay. This is right. And I get a call on a Friday and the broker goes, hey man, the other guy that dropped this out of contract, he's coming back in. He's going to put $600K hard day one on a $10 million deal. It was only a $10 million deal. And he goes, he's like, unless you guys can do that. And I'm like, I can't, no, I'm not doing that. Like it's ludicrous. I was like, I had to take like that one. I was mad for 10 minutes instead of 5.
Well, what do you do to recover? Because I see you going through a process, and I think it took longer than 10 minutes, Garrett. What do you do? What do you do when there's such a disappointment?
You have to remind yourself that there are things that are out of your control. And as long as you're doing the process over and over again, and that you do the same process, it can work, you've seen it work, you have to play it. It's more of a mental game, and you have to be ready for that. And so you have to, there's nothing that beats repetition. You need to lose. You need to get in there and lose, and feel what that feels like. Feel it inside of you, that the hurt and how upset you are. And then you need to take that and channel it into your next quest. All right, I'm going to use what I learned in that one, and I'm going to get back on the bike, and I'm going to try it again. And maybe I'll win that one, and maybe I won't. And be okay with either result. Mm-hmm. If you're okay with either winning or losing, then just regardless, you're going to give it your best shot. Everything you're doing, there are things that are out of your control. And if you do it enough, eventually you're going to get one fish. All you need is one.
Yeah, so true. It's you're really committing to the outcome, and being okay with
Who says that? Hell, Rod.
That's the miracle equation. It's you're committing to the process. That's right. You're committing to the process because the outcome is then inevitable once you do that.
The outcome's inevitable. You say, listen, I'm just going to do the steps over and over and over again, and eventually, hopefully, something hits. I don't know when. It may not happen now this year.
But the other thing, it's not all lost, because when you do lose a deal, it's not all lost because, number one, you've learned a lot. You probably expand your comfort zone, your confidence, but also you've built a rapport with this broker. I mean, you lost this deal in North Carolina. What was the broker's opinion of you after that? I mean,
he was like, I got to get you another one. I got to get you one. That was his. He felt like he let me down, even though it was out of both of our control at that point. Yeah. You know, he took me through the whole thing. I came to the table, I played the game, and I lost, and he felt indebted to me almost. And so we've kept a good rapport since then, and he knows that we're serious.
Yeah, that's right. So it's actually, there's a benefit coming from that. Not as good as a deal, but still a very strong benefit. And in fact, that may actually lead to another deal, which leads me to this other thing. This deal we have right now, currently in Atlanta, it was actually a deal that I don't know. Did we take a swing at that earlier? Did we maybe lose that? In other words, what happens when you get outbid by something? Do you do you track that deal? Do you move on?
So a really good practice is, even if you get outbid and you lose a deal, put their timeline in your calendar so that you can follow up on when they go under contract, when they go hard, and then check in with the broker. Hey, did they put it under contract? And the timeline there is about 7 to 10 days. Did they actually go under contract on that? Okay. And then if they did, all right, how's everything going? Check in day 15. Check in day 30. Did they go hard? Once they go hard, there's a good chance it's closing. So you could still check in, but realistically, if you track it, put in your calendar to check back in on it. If for whatever reason it falls apart, which happens a lot. Actually.
Yeah.
Happens all the time. You're the next guy up. Take it down. So it's like, you went into this right now. There's a lot of deals that hit the market, and you got to compete. And there's like 30 people looking at it. Right. But if you can kind of hack it and it falls out and you're the next one up, like, all right, let's go. That's an advantage.
Well, look at the Atlanta deal. Or let's say super competitive, and someone finally wins the best and finally. Well, what happened from that? How did we end up with that deal?
So we ended up with this deal because I was talking to the broker, just having a casual conversation. You got to remember, these brokers also, they go through so many deals. They forget about deals. So you have to ask them questions on the phone.
So weird.
Hey, there's got to be something that I'm not seeing here, that maybe a deal that fell out of contract. You got to kind of prod their memory to get them to think about the deals that they're not paying attention to. So this deal in particular, they stopped paying attention to because it fell out of contract 2 times. They're like, you know what? I don't want to deal with this anymore. We're not going to make the commission. Let's move on to something else. And I pulled it out of his memory, and he said, oh, actually, this deal just fell out of contract during COVID. Maybe it's something you like, and take a look at it. And so they sent it over to me.
Why did they not pursue this? Explain to me the psychology of that. I don't quite understand. There's giant listing.
They're trying to make commissions. So their job is to do a volume of deals. And if they've run into hurdles, it's like the ease. They want to take the easiest route to get to the sale, the close. Okay, if they have a deal over here that they know is going to close really easily, and there's going to be a high competition, the price is going to be driven up to the ceiling. That's more attractive to them than the deal that they've lost twice because of one reason or another, right? But that's your opportunity to go in and get it. You got to bring it up in their head. Hey, there's got to be something that I'm not seeing that's not online. Maybe a deal that just fell out of contract. Maybe something that you're just tired of dealing with. Does that exist? Is that in your pipeline? And they'll be like, oh, actually, yeah, let me send this. And then that's what happened with this one. And then I had an uninstructed shot at this deal because I didn't have, if they would have brought it and relaunched it back to market, it would have been a different story. I would have been paying more money and I may not have won it. But because I pulled this out and I acted fast and we came in aggressive, we were able to pick it up, and it was pretty unobstructed in general. And then we were able to get a discount on the pricing and really good terms in general. And so that was a really good angle. And this was, a unique situation, but it's something that was pulled out of thin air because I asked the right questions to the broker, and we moved fast. And we showed ourselves a serious player.
And this is not an isolated incident. I mean, anecdotally, it almost seems like half the deals fall through. And if you're there and you're staying at the heart of it is that you're really staying in touch with brokers. What is kind of like your system, your cadence, and the style of communication? How do you stay in touch with brokers, and how do you do it?
So I really just, I put a lot of it on my calendar. So I have I think the easiest way to do it is to target the brokers in the markets that you want to build the relationships with, and put it in your calendar. Check in with this broker, and actually call them, leave a message, shoot them a text. Hey, we should catch up. And try to get on phone calls with them if you can, because that's how you're going to be able to ask the questions that you want. And then when they finally have a deal, come with knowledge. Like don't just come in and like ask the basic questions. Show that you've actually researched it and you understand it, and come with like really thoughtful questions to the conversation. And these guys they have a ton of people calling them all the time. So again, you need to stand out. And so if you come with thoughtful questions and you're building that rapport on the deal, and then if you end up landing one in the market, you need to let all those other brokers know about it. They need to know, hey, we do have a deal in Atlanta. Oh, wow, they actually got one, and they're putting in a contract, and hey, when we closed on it, I tell all the brokers again, just so that it builds that demand for us in general. And so that's kind of the cadence.
I love that. So a reason to call the broker could be, hey, we just closed a deal. We just got it under contract. There's a deal you sent me. Checking on a deal that was closed. Any other reason that you can give someone so someone takes a 10, 15-minute call with you because you're like, hey, just want to catch up. Broker's like, I don't have time for that. Like, what reasons do you give a broker that they go, oh, yeah, let's hop on the phone?
So we're coming out, and we're going to be really aggressive on our next deal. We're really going to come out with attractive terms and an attractive timeline, and more than we've ever done before. And I love to tell you about our next plan, our next play, and kind of leave it open in their head, and they're like, that sounds interesting. Or I'm partnered with someone, if you don't have the track record, I'm partnered with someone and they want to be really aggressive, and I think it's going to be interesting to you. Can I talk to you a little bit about that and see if there's an alignment with something you got coming out to market?
I love it.
You frame it like that. Leave it a little bit of a mystery, and then they'll jump on a call, and then you can dive in and, hey, tell them what you want and see if they can produce.
Yeah, love it. Anything that I like the mystery part. Anything that informs them that you're going to be closing on that next deal, that will get them very interested. Now let's shift slightly here through COVID. Obviously, people always say, "Oh, should I wait? Should I until And there are some of our peers who are maybe waiting a little bit and kind of not doing anything. We have decided not to pursue that route. Instead, we have changed our underwriting a little bit. We haven't changed our strategy, but our underwriting a little bit. Can you talk about some of the ways that we had adjusted our underwriting, for the current times?
Yeah. So a lot of the underwriting falls back on what you can do with the debt first. I think a mistake that a lot of operators are making right now is they're not understanding the new debt structures that exist. And you need to have a really good relationship with your mortgage broker or your lender, understand the types of debt that are out there first, and then back into your deal based on what's available, because that's where we're seeing the most volatility in general. You're hearing that there's really good debt terms. There are, but you need to understand their criteria in general. So right now, for example, the product that I like the most, and there's different products, right? Before there were many products, now there's a few because of COVID. So you're gonna need to know those products really well. That is like 80%, 75 to 80% of your capital stack is in the hands of the lenders. So you need to know, and what I mean by that is if you have a $10 million deal, 70 to 80% of that rests with them. So you need to understand that product so well, and then back in your underwriting around that. And a lot of people are not paying attention to that. In addition, not just that product, you need to know it so well as how it's going to affect your exit. You have to plan for the exit in mind and understand when you're going into the deal what that's going to look like. Figure that out, and then tailor your underwriting around that debt product.
Well, hold on. So you're right. Sure, the underwriting has to reflect that problem, but it's one of those things that, it's like buying insurance. It was like one of those things where debt is debt, and we're just gonna get the cheapest one. And we didn't think about the exit, right? And so some of the stuff we did several years ago, we're like, oh my gosh, we would really like to exit this. We'd like to sell it. We'd like to refinance it. We added all this value, and then come to find out, we have a giant defeasance penalty of $900,000 on a $3 million deal, and you're like, oh crap, I can't refinance. I can't get a supplemental on this. It's like one of those things you kind of go, I mean, it's a great cash generation machine. It's fantastic. It's printing money. Great. But the value is in the equity, and we can't get the daggone equity out. And so we're starting to pay a lot more attention to the exit. But let's talk about some of the differences in debt products. And when you say pay attention to the exit, how are you aligning your debt with a potential exit?
So some people like the 10-year fixed model, and they want to go in with, so right now the main types of debt that are available in COVID era is agency debt. So Fannie or Freddie. Fannie is fixed rate loans, long-term, low interest rate, high leverage, with no ability to take any CapEx and put it on the lender. Okay. And then Freddie is similar, but they offer a floating rate. So you can get what's called a 7 or 10-year ARM, and that allows you to exit a deal after the first year for only 1% versus having a large prepayment penalty.
ARM sounds risky. It sounds like we got ourselves in trouble in 2008.
You could look at it that way, except the really cool caveat about that is that you can do what's called a cap. You can buy a cap on the interest rate. And what that allows for is you're simulating a fixed interest rate, but you have the benefit of exiting at any time that you like after the first year for only 1% fee. Now, think about this. If you lock yourself into a 10-year fixed rate loan and the operation doesn't work out the way you thought it was going to, but you still have the opportunity to make money by selling and doing good by your investors, and they're going to love you for it. Anyways, let's say you want to sell in year 2. Well, if you try to go sell it and you're in a fixed rate loan with a high yield maintenance penalty, okay, you're not going to have any profit left over because they're going to charge you $1 million just to get out of the loan, and now you're handcuffed. So you want to do well by your investors, but because you chose the wrong product up front, it's not going to work. So I put a lot of value on flexibility in general. If I can work any kind of flexible loan that makes sense, I'm going to try to go for that over long-term fixed rate, just because I want to be able to do what I want. I don't want to work for them. So I personally right now, the best product I like is the Freddie Mac 10-year ARM. Now, what it allows us to do now, the caveat, why would you not do that every time? Because you're not going to get as high of proceeds necessarily as you might with Fannie. So maybe you could get 78% with Fannie Mae right now in this environment. With Freddie Mac, you can only get 75%. Okay. So that's the trade-off. So it has to underwrite to that. Right. But I think that's the best option right now if you're trying to, get into a deal and add value. What was going on before is we could get bridge debt that's similar to the Fannie. We could actually capitalize the CapEx budget. So that was very attractive to us before. Now those products, they exist, but they're so expensive, it doesn't even make sense to have them right now. So, it's limited the inventory and what you can do, but overall people don't focus enough on the exit and what potentially could go wrong. I would rather have the flexibility to get out whenever I want than have a little bit better interest rate and a little bit more proceeds and be stuck in a deal for 10 years.
Yeah, and that's right. And these caps actually end up not being much higher than 10-year fixed.
Yeah, and this is the other thing that I don't think I want to shed light on this. This is really cool. I figured this out on the last deal. So one of the deals we did, I figured out that if you do a 12-year loan with Fannie, now if you're going to do Fannie, you're going to get great interest rate, you're going to get great leverage. there is a way to do it. You can still exit properly. And instead of going for the 10-year Fannie loan, go for the 12-year, because what it allows you to do is get 2 supplementals. So that the lender will actually grant you not 1, but 2. And why that's beneficial is because the first supplemental will allow you put on the deal. It's almost like simulating a refinance in a way, except it costs less. It's another loan that you can put on, and that loan will displace the capital that you put into the deal. So you can take investor money and distribute it back out. But now let's say you want to sell the deal. Let's say you bought it for $10 million, okay, and it's worth $20 million at time of exit. And but your loan is only for $8 million. Well, you have this large gap. What person's going to come in with 50% equity for your deal? No, then you're going to have to lower your purchase price to help meet that, right? So the second supplemental allows you to lever it up to a level where you can exit and simulate it the same way as if they were going to go put new debt on it. Now, they probably won't have IO, which is not as attractive.
IO is what?
But interest only.
Yep.
But they will have the high enough leverage, so maybe they can come in at 75% LTV on the exit. And you can't get that with a 10-year. You have to go for the 12-year loan in order to get that. So that's a cool workaround that I figured out that you guys can use.
So debt is something that has certainly changed. Bridge debt has certainly gone away, at least for the moment. Fannie and Freddie kind of stepped up their game. I think they've become a little more flexible, a little more aggressive about those things. We like. We're now paying a lot more attention to the exits because of that. What are some other, and that has affected the underwriting, of course, for that as well. And your point was make sure that you know your debt product and work it into the underwriting, because if your LTV is lower, it's going to affect your possible returns and your price. What are some other ways that we have changed our underwriting to adapt more what's going on in the market right now?
Yeah. So first off the top of my head is the natural market appreciation, 0. Year 1, 0.
Come on, Garrett.
Even 0. Jeez. Yeah, dude. I mean, it's the market right now is too crazy. We don't know what's going to happen. So if the person you're looking to invest with isn't at least taking the year 1 natural appreciation and putting that at 0, I would be concerned, because look what's going on. The pro forma is a prediction, and we're trying to make predictions with insulation so that we can actually hit the numbers that we say and produce the returns that we say we're going to. And so that's the first way I think is important to make sure that that's going on. The other thing is your reversion cap rate. You want to pay attention to that.
What's a reversion cap rate, Garrett?
So it's like when you go into a deal, you're going to buy it at a certain cap rate, okay? And then when you sell it, so let's say in the market right now, similar vintage, and you have to pay attention to the vintage property, the location of it. Those are really the 2 main things is the location and the vintage. So it has to be similar. Those properties are trading at a certain cap rate, okay? And if let's say it's 5% is where it's trading right now. Well, you want to have some cushion in there. When you exit in 5 years, it's probably not going to be the same landscape. So in order to be conservative, we're doing a minimum of 50 basis points over where the current reversion cap rate is.
That's 0.5%. So at least 0.5% over where it is now. So in your underwriting, we're using at least 5.5% on the cap rate at exit or refinance, sometimes even higher. And this is the thing when you see, this is a mistake that's a lot of passive investors make. They just compare returns from one offering to another. But what's really important is the actual underwriting, which means the assumptions are made. Because if I keep my reversion cap rate at 5% or even accidentally, quote, lower it swings the return wildly. So 0.5% higher crushes the return. So which means that if we can still deliver a 13, 14% whatever return with a reversion cap rate that's at least 0.5 point higher, that's another example where we can be conservative. And like you said, we really want to hit those numbers. We want multiple layers of margins for error in there. What else in your underwriting that might be a little different to pay attention to?
So one big thing that I think is very important, especially right now, are cash reserves. So you're going to get, there's the change in the market. The biggest change is you have to come with a lot more cash to your deals. There's right now, every lender under the sun is pretty much requiring a minimum of 9 months, but up to 12 months principal and interest reserve that you have to put in escrow, and it just sits there. Okay. Now you can model that in to get redispersed back out to investors at a certain point. You could keep it around just as an additional reserve as well if it works in your model. But we always make sure we have enough cash, because there's things that maybe come up after the closing on your CapEx plan that you didn't find. There's different reasons why you're going to need extra cash laying around. And the worst thing that can happen is that you run out of it. So sure. I think making sure you have enough cash reserves, minimum of 10% of the total amount that you're going to spend on the deal. But if you can do more, do more. And then just make sure you have that ready to go. And so, now there's a lot more cash coming in because you have to fund 100% of the CapEx with cash too. So it makes it more challenging. Luckily, the interest rates are low, so that helps. But that's just something to pay attention to, is how much cash. And then the other to go with that is, I like buying right now. You got to buy cash flowing deals. They got it right now. The deal that we're buying right now is 99% occupied. It's cash flowing from day one, and not only cash flowing, but know your demographic of who your renters are before you get into the deal. What are those people doing? Are they just all on unemployment right now, and that's why the property is still cash flowing, or do they still have jobs? If you can figure that out, then you'll know your exposure before you're getting in. Like, we know that on our asset that everybody's still working because of the demographic type that's on site. And we did due diligence on that. So we know that we're in a good place. But if you find that you're going to buy a property and everybody's on unemployment, that's a big risk.
Garrett, I'm so glad you're on our team, because you are just incessant looking for deals all the time, and you'll not give up. And at the same time, while we're being aggressive at making offers, we're not aggressive about underwriting. And therefore, hey, we haven't done 4 deals so far this year, and that's okay, because the one we have doing right now is super, and maybe we'll do another before the end of the year, or maybe we won't. So, Garrett, thank you so much for being here, sharing your ninja tactics on finding deals, underwriting deals. So thanks again for being on the show.
Thank you, Michael. It's been a pleasure.
I hope you found that valuable. This was a little bit more of an advanced thing, but sometimes I think it's necessary to kind of get a little bit more into the weeds about how do you find deals, how do you underwrite them, what are we doing differently right now, and I hope you found that valuable. And I think the key thing, the thing that everybody has in common who are successful is hustle. And they're doing a little something every single day. Now, Garrett mentioned his underwriting and mentioned that we have this great tool called the Syndicated Deal Analyzer, which we do, and it's super affordable. And at this point, it's probably the most widely used syndication underwriting tool on the planet right now. So just Google Syndicated Deal Analyzer or go to syndicateddealanalyzer.com. It's super affordable, super powerful, allows you to do the simple things super easy, and also the advanced ones. You use it in all stages of the deal, as you first make that first offer. Once you get the LOI, into due diligence, and finally even closing, you can use it to create your projections for your pro formas as well. So check that out. Also, if you are interested in investing with the investment firm NightHawk Equity, go to NightHawkEquity.com and click on the join button, because you can join our investment club. Now, why do we do that? Because we want to get to know you first, right? So you're going to fill out a short form. You're going to schedule a call with us. We'll have a conversation. We'll answer your questions. We'll make sure there's a fit for you. And then you're in the club, and we can then share with you some upcoming investment opportunities. Like I said, we just closed a round on the 130 unit in Atlanta, and Garrett is feverishly working on the next deal. So make sure you hop on board and check that out. Great. Thanks so much for your time. I appreciate it. Catch you guys next episode. Hey, and before you leave, make sure you subscribe to my channel below. We put out videos every single week, and you don't want to miss it. Also, if you haven't done so already, grab my free ebook here, okay? It's a secret to raising money to buy your first apartment building deal. It's a good one, so grab that. And hey, check out another video.